All right, we're getting started here. Welcome to the inaugural 2020 Grain Market Update Series. I'm Keith Petersen from Barchart, and I'm joined today by Alan Brugler from Brugler Marketing. And we are very excited to do this inaugural live stream with our audience today. We got a fantastic sort of webinar live stream on tap for you, and this is going to be a series. So if you haven't signed up for everything coming up throughout the growing season, definitely subscribe to the series. You should be able to find that on the platform. We've got a great lineup all throughout the growing season, and the way we're going to be doing it is we're actually going to be previewing all of the WASDE releases the day before. So you're going to be up to date on everything that's going on in the market. Today's gonna be a little bit different. You know, the WASDE report was actually yesterday, as you probably all know. We're doing that because during the season we're going to be actually releasing some forecasts around yield estimates throughout the growing season. We haven't started publishing those yet. That's going to be our first. We're going to be publishing those in the beginning of June. So until then, it didn't really make sense for us to do a preview. So that the way that it's structured today, Alan's going to come in and he's going to do a nice little what's new in ag. That's what we call it. That's our segment where we bring in market analysts that tell everybody what's going on in ag, what to look for, what's going on, and provide a little market expertise. Then normally in the future weeks we're going to be doing a preview for WASDE, or we're going to give you a sneak peek at our yield forecasts ahead of the WASDE numbers, which is pretty exciting. And hopefully you stick around for the series to check those out. And then lastly we'll be doing a Q&A. So today instead of us talking about what's coming up for the WASDE report, I'll actually be going through our recent white paper that we released on our yield forecast indexes and how you can use those to kind of get ahead of the USDA with their crop production numbers and the agricultural yield survey. So before I kick it over to Alan, just want to say again, thanks for joining. Definitely remember to subscribe to the series. It's going to be fantastic. We've got a ton of great guests coming up in future reports. Jackie Holland from Farm Progress, who's the grain market analyst over there. She's going to be coming up on I think in July. Mike McGinnis from Meredith, the Chicago Markets Bureau chief over there, is going to be joining in August, which is going to be fantastic. And then we've got Scott Shalady from Merrick Spectron. You might know him as the cow guy. He's all over the place, but he's always wearing his cow jacket. Fantastic color on the market. So we got a great lineup for everybody. But for today, I'm going to kick it over to Mr. Brugler, a man that really needs no introduction, but I'm going to give it to you anyways. He's the president of Brugler Marketing and Management and the former senior analyst and director of analysis and product research for DTN. And then was previously the director of market information services for Ohio Farm Bureau Federation, all the way from 1978 to 1992. So Alan's seen it, everything that could possibly happen in ag markets. He's been there, he's seen it all, and he's been writing commentary on the market for over 40 years. So with that said, Alan, I'll kick it over to you, and you can do what's new in ag.
Well, thank you very much. We're going to do a little bit of a slideshow here, just a few slides talking about what USDA told us. And let's open that file up right here. And you should have that on your screen. USDA gave us a little bit of information yesterday that I want to highlight. The numbers in red are the old crop corn supply and demand numbers that USDA changed yesterday. Some of you will recall that they did a resurvey of some of the states in the upper Midwest to see if the yield of production had changed. They did actually lower production by 29 million bushels. They cut the yield a little bit. So that tightened up our total supply just a smidge. The bottom line here on the old crop is the carryout of 2098. That was only up 6 million bushels from last month. So the trade had been looking for a much more bearish old crop number than what they got. And we did get a little bit of a rally in the May and July corn yesterday because of that. we've got some proprietary numbers down below that show us that if USDA's cash average price of 360 is what we end up as a final, we would expect the futures range for this year to be something on the order of 327 to 441. That'd be an average since 1980. What we've actually seen so far is 301 to 402. All right, so we've had a $1 range. Those of you who don't think marketing is important, if you're in the ag business, take your corn production and multiply it by that $1. That's how much of your income is based on your marketing skills this year. Point out the other white column over here on the right side. That was the first go for 2021 production. They went with a 97 million acre planted acreage forecast, but nobody really thinks that's where we're at. That was the March intentions report. That was back BC, before COVID, and that's changed a lot of people's minds on a lot of different fronts. We'll build on that thing going forward here. A few things we know. Commercial elevators own very little corn right now. This is the Commitment of Traders report from CFTC. The purple line there is the commercial short position, which is the elevator hedging. They have very little corn hedged right now because they don't own much cash corn. This is the ingredient for a rally. If the market demand starts to pick up, the elevators don't have the corn. They're going to have to come after it from the producer, either with stronger basis or stronger futures. The other side of that is the blue line. The commercial position is fairly large, so they've been buying corn futures because they want to lock in this low price. Neither of these is good for futures at the moment because the spec funds are on the opposite side of those trades, which means they have a big short and a small long, and price tends to follow their net holdings. But again, this is basically telling us there's not a lot of commercial ownership of corn right now. This is a net of that position. You see the red line going down. That's the fund short position getting larger. Any good rally is going to start with short covering. Go a little further. One of the biggest side effects of this whole COVID-19 issue has been the stay-at-home orders and the businesses being shut down, people told to work from home or go on unemployment, 14.7% unemployment right now. What you're seeing here is the impact that's had on ethanol. With nobody driving, we haven't been using the ethanol, and we've had over 70 plants that have had to shut down due to negative margins. As this red line collapses, that means we're using a lot less corn. You'll notice the last 2 weeks we have ramped production back up. Some of the plants that were on maintenance have gone back to at least partial production. A couple of Anderson's plants in particular were shut down and have announced that they're restarting. So we're starting to see some increased corn usage again. We think this will improve as we go forward. With all the plants shut down, the basis weakness and so forth, we did see a 14-year low in cash corn prices in late April. We took the board clear down to $3. We took the cash prices, you see here, national average on the low from commodity, went down to $2.75. We are starting to see a little bit of improvement there in the last few days. Now, the corn-soybean situation. This is a corn-soy ratio, soy-corn ratio, traditional. It's a little noisy, but if you look at the blue line, you'll see that back in March, when USDA found that 97 million acres of corn intentions, that soy-corn ratio was only about 2.35 to 1. That's a toss-up between planting more corn and more beans. When you get above 2.4 or even 2.5, the market is telling you it wants more beans and less corn, and we do tend to see a shift in acreage. What you see here is that the ratio is now 2.55 to 1. It's strongly telling you, as a producer, if you haven't planted the corn and you don't have to plant the corn, don't plant the corn, go to beans instead. And we think this has resulted in some acreage switching. As we've talked to our farmer clients who are in 17 states, we are seeing some switching from corn to beans. in cases where they don't already have the fertilizer on or the chemicals on. Switching to the beans just for a moment. Bean situation's a little friendlier in some ways than the corn. This is the USDA's soybean stocks ratio for the world. So this is the first go for the year. They'll revise these for another 36 months in a row. But as you can see, they're currently saying that the soybean stocks as a percentage of use would be the lowest in 5 years, and that would tend to be price supported. We should not have to go down to 780 like we did last year on nearby futures if the stocks are this much tighter than they were a year ago. One of the wild cards, of course, is Chinese buying. This is from our Ag Marketing Strategy Group PowerPoint presentation last night. You can see that Chinese purchases for the current marketing year just barely running ahead of a year ago now. It's been a little different curve shape. They bought a lot more early. But the key is they're still about 15 million tons below what they would have bought historically. We typically be at 25 to 30 million tons going to China. Cumulative commitments right now aren't even quite 15 million. So what's the impact here? If they're going to honor the phase one trade deal, then they're going to have to buy a lot more beans. They're buying other things too, of course, corn. But this is, if they stick on the current pace, you're just looking at last year's totals, and USDA is still too high on exports. That's one reason they lowered the soybean exports 100 million bushels here on Tuesday. Just a couple more points here, and then we'll turn it back over to Keith. One of our other things that we do at Brugler Marketing is what we call condition seasonal. This is a sort of a quant study. We look at July corn and July beans between March 1st and July 1st on the premise that we're going to sell some during that time period. What this tells us is that given where we started the period, 910 back on March 2nd, we would expect that the low price for the period, for that 4-month period, would be around 828 based on historical performance during this time period. Now, that's statistically cheap at that price, and you can see that every time we've got down to that level, the market has bought it. Whether that's the quant funds or the commercials, we don't know that, but the market is being well supported at that number we turned out back the 1st of March. Because we are in the below the up year's best fit low, it's probably a down year where we would be below 910 on July 1. Not written in stone, but the odds are pretty high. But even in a down year, we could trade due to normal variability as high as 960. All right, just a couple more slides and we'll be done here. This is the soybean supply and demand from yesterday. Again, the red numbers are the ones that USDA changed. They did raise the soybean stocks to 580 million. That hurt us today on the beans. We were down double digits on beans today because that's a little more burdensome old crop supply. I would point out on the new crop side that they were only going with 83.5 million acres. Again, that's going back to the March intentions. We think that number is going to be closer to 85 or 85.5 going forward here. We won't know for sure till the end of June. Keith's going to start talking about yield here and their yield indexes. USDA is using 49.8 bushels per acre, which would be, I believe, the third highest ever for their trend yield for soybeans for this year. But when everybody gets bared up about corn, and you may have seen the 3.3 billion bushel ending stocks estimate for next year, they're assuming a fairly high yield of 178 or 179 type of a yield on fairly big acreage. This is not set in stone. We've got a lot of weather developments between now and harvest. Even conservatively, we could take that 49.8 from USDA down to 49. You can see that it was 47.4 last year. Certainly, worse weather problems takes it down. So being able to measure those yields on a continuing basis can really change these statistical bottom line figures we've got here. Even at 49 bushels, we can get the ending stocks for the U.S. beans down to 354. And the cash price under that scenario would be 60 cents higher than what USDA released yesterday. So at this point, that's what's going on in corn and beans. We can build on those themes when we get to the Q&A later in the program. But I'm going to turn this back to Keith.
Yeah, thanks, Alan. That was fantastic, super informative, and you're definitely gonna be able to dive into some of these themes a little bit more in the Q&A later on. I think we didn't hit on COVID too much, but that'll probably come up later. But fascinating stuff, and yeah, definitely appreciate the market update. So with that said, I'm going to provide the audience with a preview or a sneak peek of our new white paper that we just released. So I talked about it earlier on, and Alan mentioned it, but we're finally officially releasing our yield forecast, where we're actually making forecasts for yield, season ending yield figures down to the county level, all the way up to the national level. We're going to be releasing those every day to our Commodity View Pro subscribers. Anybody that uses our software is going to be able to get daily updates for those yield estimates, like I said, down at the county level and upwards to the national level. Additionally, we're going to be releasing a free report that anybody can register for. You just go to commoditydata.com or barchart.com/commodity, find our price report section there. There's a bunch of cool price reports. You can sign up for a U.S. grain price report, international grain price report, obviously our yield forecasts. So you'll be getting that twice a month, released on the first and third Tuesdays. And we're going to be talking about those reports. Hey, Alan, would you mind muting your mic there for a second? We're going to be talking about those reports in these monthly sessions. So I'm going to go through the white paper, what's in there a little bit. You can download that for free on the website as well. And then it's a lot more information than what you're going to see here. This is just a little sneak peek. So in terms of what's in the white paper, we provide an overview of the USDA forecast performance and market impact over several decades. So, how has the USDA actually done? What's been the impact on the market in terms of price action in the minutes directly afterwards of the release? We're going to talk about how that's been shaped by changes in production technology. Everybody knows that there's been a lot of technology advancements over the years. We're going to dig into that a little bit, and I'll give you guys a little sneak preview here. And then additionally, provide an overview of how new tech that we're leveraging allows us to make in-season insights into yield. So how we can do those daily forecasts that you're going to get published to your Commodity View Pro every day. And then additionally, we're gonna, and this is the cool thing that we talk about in depth in the white paper, and again I preview it in here. We're going to show you how you can use our forecast to actually have a good idea of whether the USDA is likely to revise up or down, or not really revise much in a meaningful way. So really useful information for your crop marketing strategy, right? So if you have a view on whether USDA is going to overreport or underreport or revise up or down, then obviously that's going to have an impact to price. And if you have a view on price, then obviously that'll impact your grain marketing strategy. So really exciting use case there. And then additionally, for anybody who's underwriting in ag, right? If you're underwriting lending for farms, or if you're writing crop insurance, having this sort of insight combined with some of our other products like basis indexes, our upcoming basis forecasts, and then our cash price indexes, you can use those to kind of make better decisions. And we talk about that a lot more in depth in the white paper than we do here. So on to the next slide here. A couple disclaimers. My lawyer made me put these in here. So, I'm not going to read all this. I take it you're able to absorb that instantly. Legalese goes down so smooth. But basically, it's saying that trading in futures is not for everybody. So don't do it if it's not right for you. And some of the results we're showing you here for our simulated trading model are indeed that. They are simulated. We didn't execute them for real. We think they're accurate, but it's hypothetical at this point. So just be aware and take that with a grain of salt. Or you shouldn't take that with a grain of salt, I should say. So digging into a little bit more around what's in the white paper itself. So as you can see here, that blue line that's kind of skyrocketing on a 45-degree angle, that's growth in yield, cumulative growth in yield over the last century, give or take, right? 1936. Starting in 1936. So, as you can see, yield has grown by over 564% at the national level over that time period, where the cumulative growth that we're showing there, kind of like going up and down around the x-axis in acreage, has pretty much changed very little, right? So intuitively, that means that all of the growth in production that we've seen over the past century, which has been pretty substantial, has actually come primarily through increased yield, right? Not acres planted. And there's a lot of things that have driven that, changes in agronomy, machinery, better machinery equipment, GPS sensors, genetics, right? Better seeds, things like that. Field applications. Is this the right time to be applying pesticide? Is my fertilization program what it should be? People just have more information, and then obviously data and software, which help people make those decisions. So those things have all been pretty big drivers in that increase in yield. And interestingly enough, right, the changes in production technology that have driven this huge spike in yield has significantly dropped the variance in realized yields over time, right? So what does this mean? Intuitively, crops have become a little bit less sensitive to growing conditions, right? You think about last year, it was all doom and gloom at the beginning of the season. Even middle of the season, the weather was, atrocious. The USDA estimates are way too high. It's going to be a bloodbath out there. It wasn't necessarily the case. I think, the numbers weren't fantastic, but they were pretty resilient. I think what you heard didn't necessarily reflect the numbers that were actually published at the end of the year. Whether you believe those 100%, I'll leave that to you. That's not for me to comment. But things have become more resilient. That is a fact. So improved yields with reduced variability have actually increased leverage to absolute yield values. So yield becomes that much more important if that's what's driving production almost entirely. Your gearing to yield itself is quite high. So all in all, that means that estimates for yield have increased importance since back in the day. Not that people were necessarily trying to arbitrage off of USDA numbers 60 years ago, but they have become more important as time has gone on. What does this mean relative to the USDA, right? So a couple things to know. So in the June and July reports, and everybody probably here knows that it was relatively news to me within the last year. But the June and July reports that are published through WASDE are actually not survey based. The agricultural yield survey is not a part of that. They are modeled, right? So the USDA basically takes that linear trend that you saw where yield was increasing, and they forecast that out, right? And interestingly enough, the USDA has gotten better at estimating final yield in June and July, and that makes a ton of sense, right? As you saw, yield is incredibly resilient to weather these days. Bad weather, good weather, maybe it doesn't matter. I don't know, but that's what you see in their model, where they're just basically creating a linear model. They're forecasting some sort of growth due to technology. And that's the WASDE reports in June and July are pretty I guess the error is lower. That being said, the crop production reports in August and on, those actually have been increasing in their variability. And I'm talking about the maximum error between a agricultural yield survey result and the final USDA number. So the variance between those figures in August and on has actually gone up over time, which you wouldn't expect, right? You would think that everything is kind of getting better around that. And we were a bit surprised that that's what the numbers showed. But for us, with our yield forecasts, and for you, our customers that have access to those, this is actually a good thing for you because you have good information throughout the growing season. So early reporting periods for the agricultural yield survey vary meaningfully from end of season reports. As you can kind of see here, in the vertical charts, the August report is quite variable. The high in terms of the percentage difference between the August estimate from the USDA and the final yield figure for corn, at least that's we're looking at here. Soybeans are very similar. Is over 4%. That's pretty high. On the low side, it's quite low, and but on average, you're talking 1.5%, which isn't crazy, but it can be meaningful. And then, as you can see over time, right, as you get more information throughout the growing season, the survey results tend to get a little bit better. They kind of zero in on those final numbers, and by the time November comes around, their stuff is usually pretty darn accurate. And there's a third-party study here where we kind of show these percentage errors. We extend that here in our own research. They're well in line. So, but yeah, definitely August, September, there's quite some variance between what the estimates are and what you're going to see at the end of the growing season versus what you might expect in October, November. So probably want to stay tuned in August and September. I took the slide out of here, and you can see it in the white paper, but we actually show the price movement in the minute before and after the AYS release through the crop production report. And the price jump in that time period is quite meaningful relative to some of the other ones, right? So this suggests that despite reduced volatility in yield, there's still opportunity for crop marketers and underwriters to make better decisions. Looks like my camera might have cut off there. That despite reduced volatility in yield, there's still opportunity for crop marketers and underwriters to make better decisions, right? So what are we actually doing with these yield forecasts? What it boils down to is we're using geospatial information derived from satellites to create measures that, machine learning models. And I'm not, the people like to use the term artificial intelligence. I'm not going to go there. It's machine learning to create these yield forecasts. NDVI measuring infrared levels in the ground to kind of come up with a proxy for vegetation. That one is top of the list in terms of impact or correlation with yield results. So that's a big input. The NDWI, this is a measure of water in the cells of plants. That also is highly correlated with yield data. Land surface temperature, air temperature, soil moisture, and then some your basic stuff like precipitation, right? You put all this together, and you can have a pretty good idea of what's going to come out of the ground. It obviously gets better as the growing season goes on, but that's what we're using. That's our quote unquote secret sauce. Another important factor, which maybe not everybody knows about, but is a cropland mask. So that basically tells you, for a particular pixel. So a pixel is, on an image from a satellite, it's a pixel just like in a photo, a digital photo. Based on the color, it's what you think is planted there, whether that's beans or wheat or corn or really anything, right? So that mask, which is what tells you what's planted on that area, that's incredibly important in terms of creating these forecasts, because beans will react differently to certain elements in like NDVI, NDWI than corn will. Wheat, it all kind of varies, right? So knowing what's actually planted there is critically important. And I talked about it earlier, but our coverage for these yield forecasts, we start at the county level, go all the way up to the nation. We are trying to forecast the end of the year results from the USDA. We publish over 3,000 daily forecasts, basically every crop growing county in the United States, every CRD, every state, and then at the national level. So that's for corn and beans, and there's a lot of data. We want to make as much data available to our clients as possible. So a lot of cool stuff to look at there. Now going into what does this mean for you? What does this mean for the USDA figures? So we produce these observations daily. The AYS results come out monthly. right? And a lot can happen in a month. A lot of weather can change. A lot of things can happen, right? So having a better idea of what's happening during those time periods, you can have a good idea of what the USDA is going to release in the report. And if there's a meaningful jump between what they reported last time and what they're going to report this time, then there's a meaningful price move. So if you can use our daily figures to sort of quote unquote front run the USDA revision, then you can benefit from that. And we can predict with relatively strong accuracy. Again, check out the disclaimers at the beginning of the report, whether the USDA is likely to increase or decrease its forecast in the next scheduled report. So that's based on our model. What we provide to you is the data for you to create your own models on your side, and you can do these same sort of things. So we get into, I'll show you a little bit what we did here, but definitely check out the white paper if you want to learn more. So what we did is anytime our forecast was over 1.75% higher or lower than the previous USDA's forecast, we said that if we were forecasting lower production or yields, then price would go up, and vice versa. So we would either buy or sell futures depending on what our yield estimate came in relative to the USDA's previous estimate. And the results were over the period of 2014 through 2020, assuming an investment of 10 futures contracts as for every signal that we generated, we did pretty okay. So signals were generated on 14 different report days from September 14th to Jan 20, with a net profit of $19,000. That's based on trading 10 futures. On 12 out of 14 report days, the USDA revised their estimates towards our forecast. So 12 out of 14 is pretty good. I'll take it. 14 out of 14 would have been good, but I don't care what sport you're playing, but that's not bad. And then on those 2 out of 14 report days, they did not revise their estimate as expected, and we generated a loss on our hypothetical trading model. So again, the numbers are just there so that you can kind of understand how it might be implemented in the market. And what we're doing there is buying on the open and selling after the report. The table here is what's really important. That's for corn. So maybe we got lucky. I don't know. But turns out that beans are pretty much exactly the same. So from 2014 to 2020, we had 14 report days that the signal was generated. This one actually was more profitable based on our hypothetical trading model. On 10 of the 14 report days, the USDA revised towards our expectation, resulting in a net profit of $37.5 thousand. And then on the 4 report days out of the 14 that they did not revise the way that we expected, we lost about $6,000 there in our hypothetical model. So 10 out of 14, also good. Not as good as 12, but I'll take it. So that's just like kind of a sneak peek of what's in the white paper. Definitely check it out. Like I said, go to barchart.com/commodity. We have a whole white paper section under resources. You can subscribe. You can download that for free. I would also suggest getting access to our twice monthly reports for these yield estimates, where you can get these in your inbox before the USDA report, and then also like and subscribe. Right, smash that subscribe button. Join our series and make sure that you're here every month with us as we preview WASDE numbers. So, I'm excited for this initial inaugural kickoff event with Alan. We got more to come, and we got a lot of stuff for basically anybody that's in ag markets. And another thing that you can do to get access to these figures, subscribe to Commodity View Pro. It's basically the best value out there. You get the daily estimates right there. Get them for your county, surrounding counties, your CRD, whatever you want. Or if you need access to data for your entire enterprise, we can give you a data feed or whatever you need, right? So email me if you have any questions, keith@barchart.com. I will try to get back to you as quickly as possible. It's an exciting time, and definitely interested in talking about it more with Alan. So with that said, I'm going to close this, and we're going to start our Q&A section with Alan here. So, Mr. Brugler, thanks again for joining us on the live stream today. It's been fantastic getting your market insights. Were tremendous. So thanks for joining.
Pleasure to be here.
Yeah. So let's get right in. Right. So you know, we got your views on the markets. I'd like to hear more about, you know, how you got into the business. Like, how did Alan Brugler become Alan Brugler? What's your background? How did you get started?
Well, I grew up on a dairy farm in Northeast Ohio, Trumbull County. I went to Ohio State University. The joke is, it was 380 miles away from home, so I didn't have to come back and milk cows on the weekend. I was in an honors program there. I graduated with simultaneous bachelor's and master's degrees in ag education, but I took a lot of ag econ courses as part of that combined program. They fit the schedule, and I was interested in them. Ohio Farm Bureau hired me out of school as an organization director, which was a field man. That really tipped me in this direction, though, because as part of my job there, I was working with marketing committees in some of the county farm bureaus. We had some of the pioneers of marketing back in the day, Jim Gill from Illinois and John Martin from Purdue, come to our county and give marketing speeches. And I thought, hey, this is really interesting stuff. I'd like to get into this. Farm Bureau had a program they started about the same time called AgriMap. And when my predecessor there, Phil Luxemburger, went to the commercial side of the industry, I took over that program. And in 1980, we had a little thing called the Afghan grain embargo. The Russians invaded Afghanistan, and we embargoed the Russians and a whole bunch of things. And we had a drought besides. We had 100,000 calls on the toll-free numbers that we had set up for that program. So that kind of cemented me in the industry a little bit. Okay. And then we worked on some pioneering things like the Acres program, which was a dial-up computer network for farmers in the 1980s, run through American Farm Bureau Federation. It was kind of the internet for farmers before there was an internet, and that got me up to 92, where I went to work for DTN.
So tell me more about the transition at DTN, right? So DTN was growing a lot back then, right? That must have been a really cool time to be there. Yeah,
they had gone viral, so to speak. They had computer screens that you could put on your farm for $16 a month. They gave you live quotes and weather and all that stuff, and that was a really unique thing at the time. When I was working for Farm Bureau, they'd come and try and recruit me. Okay. At farm shows and so trade shows and stuff. And finally in 92, they made me an offer I couldn't refuse. I moved to Omaha with my family and became the director of analysis, senior analyst first, and then director of research eventually. I was at DTN for about 10 years. I wrote the morning, midday closing comments, options reports, technical analysis pieces, almost 10,000 articles in 10 years.
Oh, wow.
Keep in mind, they were small screens. They were only, I think it was 25 lines by 80 characters. So they were short. But and then I did a lot of seminars for DTN, a lot of public speaking appearances around the country on outlook and marketing strategy. So that took us up to 2002. DTN was bought out and taken private by a firm called Verona Suler in 2000, 2001 time period. A lot of the principals left at that time. We had a bunch of stock options that got cashed out for cash. Took a tax hit on that one, but
it's always good. It's always good to pay taxes.
DTN, and a bunch of farmers were starting to call me at home and saying, "Are you going to start your own service? What are you going to do next? We're used to reading you every day on DTN." Finally, one guy from Michigan said, "Here's my credit card, run it when you're ready." And I took that as a sign to start an advisory service. So we started Brugler Marketing Management in 2002.
That's great. So tell me all about Brugler Marketing Management. Like, What areas are you servicing? Like what kind of clients? What's the makeup of your client cohort look like? Yeah, tell me all about it.
Yeah, we have clients in 17 states and several other countries. Mostly farmers, what we call commercial scale farmers. That's our target. That's our main target audience. Many of our customers would have 2 or 3 or 4,000 acres and or a feedlot or two. Commercial scale farmers. We do have some agribusinesses, some food industry firms. They're very interested in aspects of what we do. But our main clientele is commercial scale agriculture. We do have a variety of different services and products available out of our Omaha office. We have Ag Marketing Professional, which is our main advisory service. We have another product called Special Research Reports, which services or feeds into AMP, but is also a separate product for decision support for producers.
Sure.
I had a slide up there earlier with the price and probability forecast for July soybeans. That would be the type of thing that we would put out as a 2 or 3 page report under SRR. Okay. We've got multiple delivery channels. We've got a website. We've got an iPad app. We've got text messaging. We've got audio commentary. As you know, we write a feed 3 times a day for your firm,
yep.
Which goes to a lot of places. And that's the fundamental side of it. But we also do quite a bit of technical analysis and quite a bit of options work with our clients as well.
Are you finding that technical analysis and options are becoming more popular with your clients? Is that growth for you guys?
Yeah, definitely growing. One of the things that I teach in my technical analysis seminars is that traders open their wallet before they open their mouth. Fundamental news is important. I think at the end of the year, that supply and demand balance sheet, that intersection that you learn in Econ 100 does set the price for the year. But it's very, very difficult to know what those fundamentals are day to day. And the current situation is a great illustration with between the Trump tweet storms and the COVID issues. There's a lot of news moving around every day. But ultimately, every trader and every hedger and every commercial participant has got to put their money on the line. And we find that technical analysis is a good way of measuring that in real time. I applaud what you're doing with the yield indexes, because that's a way of moving things a little closer to real time on what the trade thinks, at least, about the yield. But again, yes, we found that the technical analysis is a sweet spot for a lot of people. It does take a lot of time to learn, and as I taught my guys, you have to keep changing focus too, because different things work at different times. Okay. The options, I think, are also becoming a lot more popular because of the one-directional aspect of them. When you've got the kind of volatility that we've got, cattle would be a great example, where we're moving limit up one day, limit down the next day, expanded limit up the next day after that. The money really starts to slosh around there in your account. Yep. And with the put option, you can control the directionality a little bit. When it goes against you, it's not going against you past X. And when it's going for you, it can multiply pretty quickly. So I think a lot of people are understanding that that's yep. a very reasonable risk approach in this type of a market structure.
And do you find that people are more interested in that just because your average person is becoming more sophisticated, or does that have something to do with the size of your average farming operation? How that's been growing over the last 10 to 15 years, if you will.
Well, I think there's a sorting process going on there where they're getting larger because they're better funded. They're better funded because they made some better decisions. In some cases, maybe those better decisions were due to more sophisticated marketing. It's all kind of interrelated. Okay. Yeah, there's still definitely fewer farmers that use hedging and options than don't. But you're also seeing a lot of bleed over in commercial products like the min-max contracts and HTAs and MBs and those types of things that allow the producer to have some risk management without actually having to have a futures account.
Okay. Yeah, that's interesting stuff. I mean, things are changing all the time, and having better risk management strategies and better advisors to help people with that's a huge benefit to farming operations for sure.
Well, we like to think we're providing value.
That's great. So I heard the C word earlier, COVID-19. I'd love to hear a little bit about that. I know, it's a hot button item for our viewers, right? I'm currently broadcasting from my kids' playroom, which is not a standard operating procedure for me, but it's impacting all of us. I'd love to hear more about what your thoughts are on what's going on there and how that's impacting ag markets.
Yeah, I'm very pleased to say that we opened up our barbershops last week, so I was able to get a haircut before the show today. Yeah, COVID has had a lot of impacts. I think, initially the world was kind of slow to pick up that it was spreading out of China and it was going to affect everybody else. I think we definitely were blindsided by the whole packing plant situation where you've got large numbers of people in a tight area performing a very, very important function, which is making food for people. And then all of a sudden having this plant shut down because you've got 800 or 900 people that are out sick at one time or afraid they're going to get sick or having to take care of kids that were sent home because the school's closed, all of those things. So yeah, there's a lot of impacts here. It affected grains somewhat in that export trade got limited when China was down in January and February. You had it affected pork, and because you sent reefers full of pork over to China and they sat at the port because nobody was there to unload them. Or they just plugged them in and left them there for a while. Now China's seemingly starting to recover. U.S. is starting to loosen up things a little bit. Yep. I mentioned in the earlier segment about the ethanol hit that we took because of the lack of driving, people being forced to stay home. But going forward, we think that, we've probably seen the extremes here. You never know. I mean, Dennis Gartman has a great line. There's always more than one cockroach. When things are heading south on you, you tend to find more things that are going wrong at the same time. I like to think that in corn in particularly, we found all the cockroaches now. But what we need to see going forward is that we've got enough testing and enough contact tracing and those types of things to allow some more normal business activity. We're probably not going to get fully back to work or back into full employment until 2021, in my opinion. Yep. For various reasons, but steps in that direction, I think, can allow the market to recover somewhat here because I think we priced in a lot of negatives. Yep. And that's our view going forward is a slow recovery out. Some people are calling it the swoosh, not a V, not a U. Sort of up and to the right on an angle. Cool.
That's super interesting stuff. I'm bracing for a long haul here in Chicago. We have a very aggressive legislative branch, if you will, here in Illinois. They are taking the preponderance of caution. So I just ordered all of my work from home stuff recently. And hopefully I'll be equipped to ride this out for the next 3 to 4 months. So that's fascinating stuff, and certainly it's top of mind for everybody. I did notice we got a couple questions from the audience. Alan, I don't know if you can see those or if you want me to read them to you.
I see one timestamp 243 here.
Yeah, so there's one from that was in the chat. There's one in the Q&A section from 237, and then also one at 245. One from Diane.
Okay, okay. Here's I'm there now. Corn demand figures for 19 crop and 20 crop look optimistic to me. How do they appear to you? Okay, I think they're. I'm not going to say that they're optimistic. I think we have to remember where we're sitting when we look at them. We've just seen all those cockroaches. We've seen the demand hit on ethanol. We've seen the the slow GDP growth. We know that we're liquidating some hogs and some chickens particularly, but some of those things can turn around fairly quickly. The broiler sets are down 8 to 10% right now year over year, but the biology of chickens means we can turn that around fairly quickly. If the consumer is going back to work and the chicken processing plant has either everybody's immune or everybody's got a vaccine at that point, we can ramp up that chicken production pretty quickly. Hogs are a little slower, and cattle are real slow, but we are also better able to stockpile those cattle, if you will, back them up and put them out on pasture, or do a lot of different things to keep the numbers there. The big wild card there is probably, two of them. On the corn side, ethanol would be a concern. Do we get all that demand back? Do the processing plants actually all come back online? The oil industry is fighting ethanol inclusion tooth and nail, politically and otherwise. The other one, of course, is exports. Now, we know that the bullish story there is China. Okay, if they actually perform on the phase one commitments, they're going to have to buy a lot of soybeans, a lot of corn, probably some ethanol. We know they need the meat right now if the U.S. can supply it. So all of those things, I think, are out there. Just throw a bullish teaser out here, and that is there had been some rumors a couple of weeks ago that China might buy 20 million tons of corn for their strategic reserve. That would allow them to meet part of their phase one commitment, and that would be 700 million bushels plus, and essentially would totally erase the consumption losses from ethanol that we've seen this year or project to see the rest of the calendar year. So just that one decision by them could effectively change that balance sheet rather dramatically, because it does not have the Chinese buying in it right now. I'll go to the second question, commitment of traders question. Let's see. Regards to COT, producers' net position is rarely crossed to a net long position with the exception of May last year. How do you explain the reason for it rarely crossing to a net long, and why did they do so last May? The producer net position, I'm assuming you're talking, commercials. The PMPU is a category. You've got two different groups there. You've got the commercial shorts, which are typically going to be your grain elevators. They're hedging the grain that they've taken in from the farmer and haven't resold yet. The commercial longs are primarily the end users. In corn's case, it could be an ethanol plant, a feedlot. In some cases, even an exporter might have to be long depending on the type of contract. But the reason that position is usually net short for corn is because the commercial position is because there's a lot more grain being hedged out there in the country than there is the long hedges for the users. And as mentioned, we did get an exception there where we went to a net long, and that was because of the lack of shorts. Okay, if you don't have very many commercial shorts, and you do have the end user, the end user's buying because they think the price is low and attractive, but the farmer isn't selling when the price is low, so therefore the commercial short is low. So it's kind of an anomaly when those lines cross. Ultimately, what happened last year was the industry, the farmer side of the industry, sold over 5 billion bushels of corn to the elevators in about a month. And then we ended up with the opposite position, a very large commercial short with a speculative long against it. That's what fueled last summer's rally to the 460s in corn. But what killed us was all that corn needed to leave the elevator by harvest. All right, that was all old crop inventory. The elevators make their money by taking in new crop that's wet, drying it down, storing it, earning the carry. They needed to empty that house out. And as they unloaded those short positions, the funds had to get out of their longs, and prices tended to drift lower. Hopefully that clarifies it a little bit for you.
Cool. Thanks, Alan. That was helpful, and everybody, thanks for the questions. I know we're coming up towards the end of our time here, so I got one more question for you, Alan, before we jump. But just curious if you got one prediction that you have for grain markets in 2020 that you want to share with the audience.
Yeah, I would say there is a rally in there somewhere. I think we have discounted a lot of negatives. We know that the markets are mean reverting. That is, they go too far up and then they go back towards the average trend. They go too low and they go back to the average trend. I'm not saying we can't have a train wreck next fall. If we really get 3.3 billion carry out, we'll probably have corn prices below $3. But we know that over time, things surprise the market in both directions. And so I think if you've been staring at $80 cattle and you've been staring at $275 cash corn and those types of things, there will be opportunities. And the spending time on marketing is worth the effort. There are returns to it, and there are for the trader as well.
No, that's fantastic. That's great feedback. I know some people that are a little more bearish, so it's good to hear a bullish, not necessarily bullish, but the possibility of bullishness in the market. It's great to hear that as well. So if anybody's looking for some great marketing advice and expertise, definitely reach out to Alan with Brugler Marketing and Management. They're the best in the biz. We use, as Alan mentioned, we use them for content. Alan writes for us multiple times per day. It's fantastic. Our readers love it. So I can't recommend Alan and his firm and his colleagues enough. And then, Alan, I just want to say thank you so much for agreeing to join us today. This has been fantastic. Love hearing everything you got to say about grain markets, and hopefully have you on again sometime soon.
Well, we appreciate the opportunity. Best wishes to you as well.
Okay. Thanks all.